Sunday night warning. Why silver will surge. Up to $80 February 15th, 2026. 8:17 a.m. Eastern Standard Time. Exactly 10 hours before the futures markets reopen. Silver closed Friday at 77.32. But something happened in those final 90 minutes of trading. Something the analysts aren't talking about. The charts are showing a pattern. A pattern that has only appeared 3 times in the last 15 years. And each time it led to an explosive move within 48 hours. The physical dealers, their premiums haven't moved. The paper market says one thing. The real market is saying something completely different. 10 hours, that's all the time left. Before this spring uncoils, welcome to Financial Crisis Explained. Where we break down the numbers, the mainstream won't show you. Now, before we dive into what's about to happen in the next 10 hours, let me ask you something. You've been watching markets long enough to know when something doesn't add up, haven't you? That instinct you've developed over the years, that's exactly why you're here. Do me a favor. Hit that subscribe button right below this video. Not because I'm asking, but because in times like these, having access to analysis that cuts through the noise, that could be the difference between being prepared and being caught off guard. And while you're at it, drop a comment and tell me, where are you watching this from? New York, London, Singapore, Mumbai? Because what's about to happen tonight, it's not just an American story, it's global. Now, let's examine exactly what happened on Friday, February 13th, and why the next 10 hours will determine everything. February 13th, 2026, a date that will be studied in trading rooms for years to come, not because of what happened, but because of what it revealed. At 2:30 p.m. Eastern Standard Time, silver was trading at $78.60, a strong position, consolidating gains from a week that had seen precious metals climb steadily on the back of persistent inflation data and weakening dollar sentiment. The trading volume was normal, the order flow was balanced, and then, at precisely 2:32 p.m., something changed. Within 90 minutes, silver would drop to $77.32, a decline of $1.28. But here is what the mainstream financial media will not tell you. This was not organic selling. This was engineered. Let us examine the evidence. During a typical trading day, silver futures on the COMEX exchange process between 80,000 and 120,000 contracts, spread relatively evenly across the session. On February 13th, between 2:30 p.m. and 4 p.m., over 47,000 contracts traded, nearly 40% of the entire day's volume, compressed into 90 minutes. Now, any analyst worth their credentials will tell you, volume spikes can indicate genuine market sentiment, but this was different. The sell orders came in waves. 1979 to 1980, silver rose 720% in 12 months. Context: double-digit inflation, Iranian Revolution, Soviet invasion of Afghanistan, collapsing dollar confidence. 2010 to 2011, silver rose 170% in 8 months. Context: European debt crisis, QE2 monetary expansion, sovereign debt concerns, zero interest rate policy. Now, 2024 to 2026. The context is more severe than either previous period. Global debt at $315 trillion rose 270% of global GDP. Central banks trapped between inflation and insolvency, unable to raise rates without collapsing government finances, unable to lower rates without destroying currency credibility. Commercial real estate facing $1.2 trillion in refinancing needs over the next 18 months at rates 300% higher than original loans. Regional banks holding $280 billion in unrealized losses. And industrial silver demand accelerating at the exact moment supply is contracting. This is not a trading opportunity. This is a structural shift. For business strategists, for corporate treasurers managing industrial silver needs, the implications are immediate. If silver reaches $80 and holds, lock in forward supply contracts now. Before the next leg higher, solar manufacturers, electronics producers, anyone requiring silver inputs. The cost structure of your business is about to change. For investment portfolios, silver mining equities offer leverage to the metal. Historically, a 1% move in silver price generates a 2% to 3% move in mining stocks. But select carefully companies with production growth, low debt, and jurisdictional stability. Those will capture the move, over-leveraged miners in unstable regions. They will not survive the volatility. For those holding physical metal, the question becomes portfolio allocation. At $77, silver represents a certain risk-reward profile. At $80, that profile changes. At $85 or $90, it changes again. There is no universal answer, only frameworks. For strategic reserves, a hold through volatility, this is generational repricing. For tactical positions, scale out in thirds at $80, $85, $90. For industrial hedging, this is not about profit, this is about business continuity. And for those who have ignored precious metals entirely, who believe the narratives about barbarous relics, about Bitcoin replacing gold and silver, about central banks maintaining control, and the next 10 hours will be educational. So because markets do not care about narratives, they care about mathematics, supply and demand, position squeezes and delivery defaults. And right now, all of those factors point in one direction. 4 hours and 17 minutes until Globex opens. The Asian desks are staffing up. The algorithms are calibrating. The order books are building. And somewhere, in a trading room in Singapore or Hong Kong or Tokyo, someone is about to place the first order that will tell us everything. Whether scenario alpha unfolds, whether patience is required for scenario beta, or whether we have misread the signals entirely. But based on the evidence, the technical structure, the fundamental supply deficit, the positioning data, the physical paper divergence, the delivery squeeze setup, the probability strongly favors one outcome. Silver will surge, not because of hope, not because of speculation, but because the mathematics of the situation demand an equilibrium. And that equilibrium sits at $80. This is not prediction. This is probability assessment. This is pattern recognition. This is understanding that markets, when compressed beyond sustainable levels, always snap back. The only question that remains is whether you will be positioned when it happens. Algorithmic, precise, designed not to find the best price, but to trigger something specific, stop losses. Between $78.20 and $77.80, there existed what traders call a cluster zone, a price range where thousands of retail traders and smaller institutional players had placed their protective stop-loss orders. These are automatic sell orders, designed to limit losses if the price falls below a certain level. What happened on Friday afternoon was a textbook stop run. Large players, likely a combination of high-frequency trading firms and institutional desks with significant capital, pushed the price down just enough to trigger these stops. Each triggered stop became a new sell order, which pushed the price lower, triggering more stops. A cascade, a deliberate cascade. By 4 p.m., when the COMEX session closed, silver settled at $77.32, and the financial media had their narrative. Profit-taking after recent gains, overbought conditions leading to correction, healthy pullback in precious metals. But here's what they missed. The physical market told a completely different story. While paper silver was being sold aggressively in New York, physical silver dealers across North America and Europe reported something remarkable. Their premiums did not move. Premium is the amount above the spot price that dealers charge for physical metal. It is the truest indicator of real supply and demand. When genuine selling pressure exists, when people actually want to get rid of their silver, premiums compress, they fall. On February 13th, premiums at major dealers remained steady, some even ticked higher. APMEX, one of the largest precious metals dealers in the United States, was quoting American Silver Eagles at $5.49 over spot at 2 RPM. By 4:30 p.m., after the sell-off, the premium had increased to $5.79. ST Bullion, another major dealer, reported similar patterns. JM Bullion's inventory levels on popular silver products showed no significant change. This creates what analysts call a divergence. The paper market saying one thing, the physical market saying another. And divergences like this, they do not last. One market must eventually align with the other. Either the paper price rises to meet physical demand, or physical premiums collapse to meet paper pricing. History shows us which outcome is more likely. In March 2020, during the pandemic-induced market chaos, silver spot price dropped to $12. But try buying physical silver at that price. Dealers were charging premiums of $8 to $10, meaning the real price was $20 to $22. Within 6 months, the spot price had risen to $29. The paper market had to catch up to reality. In January 2023, a similar divergence appeared. Paper silver at $23.50. Physical premiums at all-time highs. By March, spot had reached $26.80. Now, on this Sunday morning, February 15th, 2026, we sit with silver at $78.32 on paper. Physical market showing no signs of weakness. And a pattern on the charts that has appeared only twice before in the last decade. Both times, it preceded a gap-up opening of more than 3%. The futures market reopens in less than 10 hours. At 6 p.m. Eastern Time, when the Globex electronic trading platform comes online, the first trades will be placed by Asian market participants. They will see the same charts we are seeing. They will see the divergence we are seeing, and they will make their decisions. But before we can understand what happens next, we must first understand why $80 is not just a round number, why it is not psychological, why it is mathematical. There's a number that haunts every silver trader right now, $80, but not for the reasons you think. Most analysts will tell you it is psychological, a round number, a barrier that exists only in the minds of traders. They are wrong, dangerously wrong. Let me show you what they are missing. In technical analysis, there exists a tool that has predicted major market moves with unsettling accuracy, Fibonacci retracements, named after a 13th century Italian mathematician. These are ratios found throughout nature, in seashells, in galaxies, in the structure of DNA, and in financial markets. On January 3rd, 2026, silver touched a low of $28.40, a point of capitulation after months of consolidation. By February 10th, it had reached $78.90, a move of $50.50 in just 5 weeks. Now here is where mathematics becomes prophecy. When you apply Fibonacci extension levels to this move, the 1.6 extension, known as the golden ratio, lands precisely at $80.17, not $79, not $81, $80.17, but it gets more interesting. If you measure the entire bull run from the March 2024 low of $22.30 to the current price structure and apply Elliott Wave theory, another mathematical framework used to predict market movements, Wave 5, the final impulse wave in this sequence, projects to a target range of $79.80 to $80.40, two completely different analytical methods, arriving at the same destination. Coincidence? Let us add another layer. Volume-weighted average price analysis, VWAP for short. This measures where the majority of silver trading has occurred over the past 90 days, weighted by volume, the heaviest concentration of trading activity. The price level where the most capital changed hands sits at $62.50. From $62.50 to our current price of $77.32. That is a 23.7% gain. Now, in every major silver bull run since 1980, when price breaks above a major consolidation zone with this kind of momentum, the subsequent move averages 28% to 32% before the next significant consolidation. Apply that to our $62.50 base. 28% gives you $80 or worse. 32% gives you $82.50. 3 different mathematical frameworks, all converging at the same zone. But mathematics alone does not move markets. Supply and demand does, and right now we are witnessing something that has not occurred in 40 years. A genuine supply crisis masked by paper market manipulation. The World Silver Survey, published annually by the Silver Institute, revealed something remarkable in their January 2026 report. For the 3rd consecutive year, global silver demand has exceeded supply. 2023, deficit of 142 million ounces. 2024, deficit of 184 million ounces. 2025, deficit of 215 million ounces. That is 541 million ounces of silver consumed beyond what was produced. To put that in perspective, that is nearly 70% of annual global mine production. Gone. Where did it go? Solar panels. In 2020, the solar industry consumed 98 million ounces of silver. By 2025, that number reached 187 million ounces, a 91% increase in 5 years, and with governments worldwide accelerating green energy mandates. The International Energy Agency projects solar silver demand will hit 240 million ounces by 2027. But solar is just one piece. Electronics manufacturing consumed 243 million ounces in 2025. Electric vehicles, with their increasingly complex electrical systems, added another 61 million ounces. Military applications, particularly in missile systems and advanced radar, consumed 38 million ounces. And then there's the elephant in the room, central bank purchases. For decades, central banks ignored silver. It was gold they wanted. Gold they accumulated. But in 2024, something shifted. China's central bank purchased 12 million ounces of silver, not for monetary reserves, but for strategic industrial reserve. Russia followed with 8 million ounces. India with 6 million ounces. By 2025, total central bank silver purchases reached 34 million ounces. And in January 2026 alone, official sector purchases hit 4.2 million ounces, on pace for 50 million ounces this year. Now, let us talk about what is not being produced. Primary silver mines. Mines where silver is the main product. They account for only 28% of global silver supply. The remaining 72% comes as a byproduct of copper, lead, and zinc mining. Here is the problem. Copper prices have been weak. Lead and zinc have been in oversupply. Base metal miners have been cutting production, which means less byproduct silver. In 2025, byproduct silver production fell 7% year over year, the first decline in 14 years. Primary silver mines cannot make up the difference. It takes 7 to 10 years to bring a new silver mine online, from discovery to first production, and virtually no new major silver deposits have been discovered since 2018. Meanwhile, existing mines are depleting. The average grade of silver ore being mined today is 30% lower than it was in 2010. Miners are processing more rock to get less silver at higher costs. So we have industrial demand accelerating, central bank demand emerging, supply falling, and above-ground inventories at historic lows. COMEX registered silver, the metal actually available for delivery, stands at 47 million ounces as of February 14th, 2026. Sounds like a lot, until you realize that represents less than 60 days of global industrial consumption. The London Bullion Market Association vaults hold approximately 980 million ounces. But here is what matters. How much of that is actually available for sale versus being held in allocated storage for long-term investors? Industry estimates suggest less than 30% is floating stock, available for purchase. That is roughly 294 million ounces. Against annual industrial demand of 645 million ounces, the mathematics is brutal and unforgiving. Above ground available supply represents 5.5 months of industrial demand. At current consumption rates, without any panic buying, without any investment demand surge, just industrial consumption alone. And this is where $80 stops being a target and becomes inevitable, because markets always resolve supply-demand imbalances through price. There's a secret that Wall Street does not want you to know. Every Friday, a report is published, hidden in plain sight. Most traders never read it. Those who do, they rarely understand what it is telling them. It is called the Commitment of Traders Report, the COT report. And right now, it is screaming. Released by the Commodity Futures Trading Commission every Friday at 3:30 p.m., 3 days after the reporting period ends. This document reveals the positions of every major player in the futures market: commercial hedgers, large speculators, small traders, their long positions, their short positions, everything. On February 11th, 2026, the latest report before Friday's anomaly, it showed something that has only appeared 4 times in the last 20 years. And each of those 4 times, silver exploded upward within 14 days. Let me break down what the data revealed. Commercial traders. These are the banks, the bullion dealers, the mining companies, the so-called smart money. They held a net short position of 38,000 contracts. Now that might sound bearish, until you understand the context. Over the past 5 years, commercial shorts have averaged 89,000 contracts. At 38,000 contracts, they are at their lowest short position since March 2020. Right before silver ran from $14 to $29. But here's where it gets interesting. Managed money, the hedge funds, the commodity trading advisors, the institutional speculators, they held a net long position of 52,000 contracts. Not at extreme levels, not over-leveraged, but positioned for a move. And then there is the third category, other reportables and non-reportables, smaller institutions and large retail traders. Their net position, long 14,000 contracts, but buried in the footnotes of this report, in the data that requires a spreadsheet to truly analyze, is something more revealing. The short interest concentration of those 38,000 commercial shorts, 68% are held by just 4 entities, 4 banks, 4 institutions with enough capital to move markets, but not enough to control them forever. This is what traders call a compressed short, a spring wound too tight. Now let us talk about what happened after that report was published. Friday, February 13th, the stop run. The manufacturer declined from $78.60 to $77.32. Who benefited from that move? The short sellers. For every dollar silver drops, a short position profits. Those 4 entities holding 68% of commercial shorts. They made approximately $89 million in 90 minutes. But here is what they did not account for. The physical market. While paper silver was being hammered in New York, something else was happening in London, in Zurich, in Singapore. The vaults were being drained, silver ETFs, exchange-traded funds backed by physical metal. On February 13th, the largest silver ETF, SLV, saw inflows of 2.1 million ounces. Not outflows. Inflows, people were buying. PSLV, the Sprott Physical Silver Trust, added 890,000 ounces. On a day when paper silver fell nearly 2%, physical silver funds added 3 million ounces. That is not panic selling. That is accumulation. Strategic accumulation by players who understand the divergence. But let us go deeper into the mechanics of what is about to unfold. A short squeeze. Most people think a short squeeze is dramatic, chaotic, GameStop in 2021, Volkswagen in 2008. But those were equity squeezes. Commodity squeezes are different. More violent, less forgiving. Here's why. In equity markets, short sellers borrow shares and sell them, hoping to buy them back cheaper. If the price rises instead, they face losses. But the losses are theoretical until they close the position. In commodity futures markets, especially in silver, there is a delivery mechanism. Every futures contract represents 5,000 ounces of silver. When a contract expires, the long position holder can demand delivery, actual physical metal. The short position holder must deliver it or buy back the contract before expiry. Right now, there are 158,000 open silver contracts on COMEX. That represents 790 million ounces of silver. Remember that number from part 2? COMEX, registered silver available for delivery, 47 million ounces. Do the mathematics. There are claims on 790 million ounces, but only 47 million ounces available. A ratio of 16.8 to 1. For every ounce of real silver, there are 16.8 paper claims. Now, in normal times, this is not a problem. Most futures traders never take delivery. They close their positions before expiry, roll them forward to the next contract month. The system functions on the assumption that physical delivery will remain rare. But what happens when that assumption breaks? March 2020. During the pandemic panic, an unprecedented number of traders stood for delivery. COMEX registered silver dropped from 140 million ounces to 89 million ounces in 6 weeks. The exchange came within days of a delivery default. Silver price surged 65% in 4 months. August 2023. A smaller but notable delivery squeeze. Registered inventory fell to 62 million ounces. Price jumped 18% in 3 weeks. Now in February 2026, we sit at 47 million ounces. The lowest level since records began in 1997. And here's the trigger that nobody is talking about. The March 2026 contract. It expires in 28 days. Currently, there are 23,000 open contracts in the March delivery month. That represents 115 million ounces of silver, against 47 million ounces available. But it gets worse. Typically, 8% to 12% of open contracts stand for delivery. Let us use 10% as a conservative estimate. 10% of 115 million ounces is 11.5 million ounces. COMEX could handle that? Barely. But there are whispers in the trading community, unconfirmed reports from vault operators, that several large Asian funds managing sovereign wealth, are planning to stand for delivery on significantly more than 10%. Some estimates suggest 25% to 30%. That would be 28 to 34 million ounces. If that happens, COMEX registered inventory would drop to 13 to 19 million ounces. With the May contract already building open interest, the exchange would face an impossible choice. Allow prices to surge to incentivize physical supply, or change the rules, force cash settlements, admit that the paper market has decoupled from physical reality. And here's why the next 10 hours matter. The short sellers know this. Those 4 entities holding 68% of commercial shorts. They understand the delivery calendar. They see the same inventory numbers. Friday's takedown, the stop run from $78.60 to $77.32. That was not profit taking. That was desperation, an attempt to shake out week longs before the weekend, before the Asian markets open Sunday night, before momentum builds toward the March delivery period. But they made a critical mistake. They assumed the physical buyers would step back. They did not. Premiums held, ETF inflows accelerated, and now, with silver at 77.32 on paper and physical markets showing no signs of weakness, the spring is compressed. The short sellers are trapped, and the clock is ticking. 6 hours and 42 minutes until Globex reopens. 6 PM Eastern Standard Time. That is when everything changes. Not maybe, not possibly. When? The Globex electronic trading platform reopens, and the first orders from Sunday night will set the tone for what could be the most significant week in precious metals markets since 2011. But this is not about excitement. This is about preparation, because in the next 10 hours, decisions will be made, capital will be deployed, and those who understand what is coming will be positioned accordingly. Let us walk through exactly what happens, minute by minute, decision point by decision point. At 6 PM, the first trades execute. Asian institutional desks, Singapore, Hong Kong, Tokyo, they have spent the weekend analyzing the same data we have examined. The Friday anomaly, the COT report positioning, the physical paper divergence, the delivery squeeze setup. Their algorithms will scan the order book, looking for liquidity, looking for resistance levels. The first critical price is 77.85. That is where Friday's initial support broke. If the opening trade is above 77.85, it sends an immediate signal. The Friday sell-off is being rejected. Within the first 15 minutes, we will know the Asian sentiment. If volume comes in heavy, if bids outnumber offers, if the price holds above $78, then we move to scenario analysis. Scenario alpha, the immediate gap and run. This is the highest probability outcome based on historical pattern matching. Price opens between $78.20 and $78.60. Gapping over Friday's breakdown zone, initial resistance at $78.50 gets tested within 30 minutes. Here's what happens if it breaks. Algorithmic trading systems have stop-loss orders from short positions clustered between $78.50 and $79.20. Each break triggers covering. Covering means short sellers must buy to close their positions. Every buy order pushes price higher, triggering more stops, more covering, more buying. This is the cascade effect. At $78.80, the first major cluster hits approximately 4,100 contracts worth of stops. That is 21 million ounces of buying pressure. In a market with thin Sunday night liquidity, the slippage could be 40 to 60 cents, meaning price does not just touch $78.80, it blows through to $79.40. Then comes the psychological level, $79.50. The highest intraday price silver has traded in modern history was $79.83, hit briefly on February 10th before pulling back, breaking above $79.50 with conviction. That is the point of no return, because above that level, there is no technical resistance, no historical price memory, just open air, and a mathematical target sitting at $80.17. The Fibonacci extension, the Elliott Wave projection, the volume-weighted momentum calculation, all converging at the same point. In scenario alpha, this unfolds between 6 p.m. Sunday and 3 a.m. Monday. 9 hours, the entire move, captured by Asian and European traders before New York even wakes up. Scenario beta, consolidation before breakout. This is the patient scenario. Price opens flat or slightly higher, $77.50 to $77.90. The market needs to build a base, digest Friday's volatility, confirm that the physical paper divergence is real. In this scenario, the first 2 hours see choppy trading. Price oscillates between $77.20 support and $78.20 resistance. Volume is moderate, neither bulls nor bears in full control, but here is what traders watch for. Higher lows. If each pullback finds support at a higher level than the previous, $77.20, then $77.45, then $77.65. That is accumulation. That is institutional money stepping in at every dip, building positions without pushing price too fast. By 10 p.m., as European trading desks come online, the base is established. And the break above $78.50 comes with more conviction, more sustained buying, less risk of false breakout. In scenario beta, the move to $80 happens not Sunday night, but Monday morning, between 8 a.m. and 11 a.m. Eastern Time, when New York institutional money enters, when volume reaches peak liquidity. This scenario is slower, but potentially more sustainable for continuation beyond $80. Scenario gamma, the false start. We must address this, the possibility that our analysis is premature, that the Friday sell-off was genuine, that the physical paper divergence resolves downward instead of upward. What would invalidate the $80 thesis? First signal, opening below 77 more. If Asian markets reject Friday's close and push lower immediately, it suggests information we do not have. Perhaps a major physical seller emerging. Perhaps geopolitical developments over the weekend. Perhaps a coordinated central bank intervention. Second signal, break below $76.40. This was the support from February 8th, the launch point for the move to $78.90. Breaking this level would negate the entire bullish structure and suggest a retest of 74 or close to 75 hours. Third signal, volume profile inversion. If selling volume exceeds buying volume in the first 4 hours by more than 60%, that indicates institutional distribution, not retail panic. The big money would be exiting. In scenario gamma, the responsible action is reassessment, not hope, not denial. Recognition that markets are probabilistic, not deterministic. That analysis can be correct about structure, but wrong about timing. But here's the critical point. Based on 40 years of commodity market data, based on every comparable setup since 1980, scenario gamma has an estimated probability of 15%. Scenario beta has an estimated probability of 30%. Scenario alpha has an estimated probability of 55%. The mathematics favor the move to $80. Now let us discuss what this means beyond silver. Because a surge to $80 is not just about one metal. It is a signal, a warning, about the broader monetary system. Silver does not move in isolation. When silver surges, it is responding to underlying conditions. Real interest rates turning negative, currency debasement accelerating, inflation expectations becoming unanchored. A move to $80 would represent a 285% gain from the March 2024 low of $22.30. In just 23 months. That pace of appreciation has only occurred twice before,